Hello, everybody, and welcome to another edition of BullionStar Perspectives. My name is Ronan Manley, and today we're delighted to have John Butler, who is with us from London. John is a famous author of books about gold, including The Golden Revolution. He is a former macro strategist in the investment banking industry, and currently John is the Head of Treasury for TallyMoney, a gold-backed currency. Good morning, John. How are you?
Very well, Ron. How about you?
Yeah, very good. And we actually met briefly, I think it was around 2014, at a gold analyst dinner in London. But it was such a brief time that we really didn't get a chance to talk. So I'm really excited that we'll finally get a chance to talk together. I guess we'll start off because at the moment, the global financial markets are looking with huge interest at what is going on with the US Federal Reserve and the interest rate possible hikes and the inflation, which just came out at 7.5%, highest since 1982. So all of this theatre has really been going on for the last 9 months with talk about tapering and inflation being transitory, which it obviously isn't. So what's your take on what the Fed is going to do now, and what are their options?
Well, they don't really have any good ones because they have a credibility problem, and it's never nice to have a credibility problem. I mean, it is largely a problem of their own making, not entirely their own making. The U.S. government itself has quite a lot of responsibility in this matter, but certainly the Fed has its share. And so yes, it's. I mean, look, the Fed is this is a mixed metaphor I've been using recently. The Fed is walking a tightrope backwards into a corner. Which
Yeah.
is
So
really
it's
not.
not a lot of options.
Well, this is the thing, right? They're trying to balance the need to restore some credibility, to still demonstrate they're able to keep inflation under control. They have to balance that with the very obvious risk that the financial markets remain fragile and over leveraged, and that if they crash the market, that will then reinfect the banking system, impair balance sheets, and perhaps kick off something at least as bad, perhaps worse than 2008. And yet they have backed themselves into this position. Now you could say, oh, in 2008, fine, the Fed took emergency measures to buy time. But what have they really done with that time? Have they fundamentally fixed anything? Have they fundamentally restructured anything? Now, of course, to do anything that meaningful would require the full cooperation of the U.S. government and regulatory apparatus, which I don't think has any real interest in fundamentally reforming the monetary and banking system. And so here we are. We have a system that is flawed. Its flaws are becoming clearer over time. The time it was bought in 2008 has not been put to good use. And so the same set of problems that we've had all along have just grown even bigger. And the Fed faces, therefore, an even greater dilemma, an even narrower tightrope, and
Yeah.
even yeah, than they have prior.
And I see that they have, we're recording this just after the CPI came out. And it just hit the tape that there's going to be an emergency Fed meeting on the Monday. So do you think that's really something that they're just doing for more theatrics because they would have known about the CPI already? Or really are they panicking?
I think panic is probably still too strong a word because the fact is financial markets still remain, or they at least appear to be, relatively stable. But I do think that there are enough calls now within the Fed, probably also the rotating regional Fed presidents who historically have been a bit more hawkish than the Board of Governors based in Washington. I suspect they're kind of demanding action now. There may have been some agreement prior that if inflation continued to rise, continued to surprise to the upside, if the Fed
Yeah.
kept getting its own forecasts wrong, there may have been some deal that an intermediate rate hike would be a possible way to restore credibility in the short run. How much time that buys, how much credibility it truly restores is very questionable. But yes, this is one possible, call it a PR exercise if you want to, one possible PR exercise that they have been thinking about. But look, I mean, if the gap, okay, fine. So let's say there is an emergency 50 basis point rate hike. Real interest rates are still as deeply negative as they were at pretty much any point in the 1970s. And so when
Yeah.
you put it into perspective and think in terms of actions and versus words, it's not a whole lot in the way of action, to be perfectly honest, if it indeed happens.
It's interesting you mentioned the 1970s because now we're seeing the CPI, US CPI, the PPI, Producer Price Index, all rocketing higher. And everyone really agrees that they're the official numbers and that they would be even higher if they hadn't changed the methodologies. So, but in this environment, there is commodity price inflation across the board in base metals, in agriculture, everything really except precious metals, gold and silver. Why do you think that is?
Well, the breadth of this commodity price rise has been unusually extensive, but you're quite right. The precious metals have kind of been left out of it. And that is a curiosity.
Yeah.
However, let's leave the precious metals for a moment. Let's talk about just the broader commodity complex, and we can include industrials, agriculture, all the typical cyclical stuff, as well as the staples, if you want to call it that, things that are always going to have some bid, some demand. Usually there's at least a little bit of idiosyncrasy in certain markets. It's not all systemic, but the nature of the COVID lockdowns, the nature of the logistical problems that were created were unusually broad and impacted the entire global economy across sectors. And so when that general negative supply shock across the commodities complex meets with all the liquidity that was thrown around, not just post 2008, but more immediate in our immediate past, to try and buffer the negative economic impact of lockdown policies, that's a recipe for inflation. Typical Milton Friedman, right? Lots more money chasing fewer available goods, and that cuts across industry, agriculture, everything you name it. But yes, you're absolutely right. Precious metals have been left behind. That looks increasingly curious. Why would sensible investors not think, wow, gee, this set of policies is inflationary. It might result in central banks panicking. It might result in a financial crisis. Shouldn't we also be accumulating precious metals? I don't have a particularly good answer for that. It is a curiosity. It increasingly is an anomaly. And when I look, I have models for these things, and I'm hardly the only one who does. And there are a handful of variables which in the medium term have a pretty decent track record. And those models are showing that gold is more than 10% overvalued here. And that is simply looking at kind of a sort of a time series of the last 20 years. It's not a long time series, which might argue that gold is hugely undervalued, relative to things like the money supply, the amount of debt in the system, the amount of leverage in the system, and so on and so forth. So yes, gold in my opinion, there's something going on that I'm missing, to be frank.
I was reading some of your commentaries on Macro Hive and looking at some of your more recent interviews, and because of your background in macro strategy, you sometimes explain the gold price in terms of like real interest rates, inflation, oil prices, and so forth. And I guess so do traders on the desks of the investment banks. They trade screen gold, if you want to call it that, XAU versus USD. And all they're looking at is what are the variables, the macro variables changing, and that affects their perception and attitude and the trades they're going to put on. But is the gold price, in your opinion, being driven by all of these? Well, we know that the structure of the gold market means that the most dominant players will create price discovery. But is it really those traders looking at those variables that are creating the price? And I wanted to explore a little bit about what your view is on the unallocated gold market, the fact that it's sort of fractional reserve credit.
Yes, that is an interesting market. And as you know, there have been some attempts at Basel, of course, to tighten up bank capital regulations and the whole Basel III implementation, which has been going on in recent months. And what one oddity there was that last year, the London Bullion Market Association objected to treating unallocated gold as any different than physical gold. They were basically saying, hey, this is just unsettled intraday trading. And so it shouldn't be impacted by these changes in Basel III. And yet they sort of admitted in their when they posted their letter of objection to the Basel Committee, they did admit that during that period of time, during that intraday period in which the unallocated gold hasn't settled, banks are effectively unsecured creditors in that market. And I was almost astonished they were willing to admit that. So in a way, right, if you're rolling over that unsecured credit position indefinitely, and yet you're receiving a cost of finance comparable to secured credit, well, that's kind of a nice arbitrage now, isn't it? To be able to fund yourself at the secured rate, even though in fact your position is unallocated, and roll it over indefinitely and pocket the difference indefinitely. Sounds like a nice business. I would, kind of like to enter that market. Of course, I can't, because the LBMA is a club which would probably not want to have a member like me.
And that's why they were lobbying so strongly to PRA, the Prudential Regulatory Authority of the Bank of England, to keep it the way it is, to keep the status quo. Now that you mentioned the LBMA, I've been writing about that for years, and it was founded by a bunch of bullion banks in 1987 at the behest of the Bank of England. And the bullion banks literally, they run the whole show, the vaulting, the clearing, the trading, even when the old gold fixing and old silver fixing were disbanded, they were just really brought back again under a different name by the same banks. So is the LBMA really just a front for a cartel of bullion banks in London? Like, you've worked in the industry, you live in London, you're a gold expert. What's your view on what these banks are really doing?
Look, first of all, I mean, the word cartel is thrown around a lot and does have a negative connotation. But let's keep in mind the modern concept of the cartel as it's used is not really that materially different than the more medieval concept of just a guild, which has a slightly less negative connotation about it. And so I think we need to understand it is perfectly normal for industries to have leaders in those industries try and set standards, to try and set regulations, and to the extent the governments, local or abroad, try to impose on the way they want business done, they get organized and fight back against that. And you could argue that the Hanseatic League is a classic case of an extremely successful fight back against governments that were trying to regulate commerce in ways that the commercials themselves thought was against their interests. Now, let's move back forward to today. The LBMA kind of exists out of a similar tradition. The power they have as basically being a self-regulating entity with minimal government oversight, essentially none, really, other than the legal system itself. Look, I mean, that's a position of power that can, in theory, be abused. And I think that it's understandable why there are concerns about that. And one could say, and this is not a facile analogy, in my opinion, to say that central banks are to their respective banking systems what the LBMA is to the global gold market, right? That is, they are kind of, the central banks are kind of banking cartels in a way that they're arguably ultimately controlled by their member banks. And those member banks use the central bank as a way to lobby the government in the event that government policy is not in the interest of the big players in the financial markets. The LBMA arguably serves a bit of a similar purpose for the biggest players in the gold market.
Seeing that you mentioned central banks, I was going to ask you about the central bank gold lending market and really the transactions, purchases and sales in London by the Bank of England. Really, the Bank of England facilitates all of these central banks to buy and sell gold, to lend gold to each other, and the bullion banks then are part of that process. But the whole thing is very secretive. And the BIS in Basel has various nominee accounts in the Fed, Bank de France, Bank of England, and the IMF gold as well. Everything is very secretive. Why do you think they keep it so secretive? Is it because if it wasn't secretive, everyone would really know that there's like wait lists that are the same bar as in a few different holdings, and that they're using the gold loans have been out there just rolling over for years and years, and it's not actually on the central bank's balance sheets?
Look, obviously, markets that are opaque lend themselves to abuse. That does not mean that there is smoking gun evidence of abuse here. There have been bits and pieces of circumstantial evidence of abuse for an awfully long time.
Yeah.
But I'm not sure it's ever amounted to a smoking gun. However, you do get this sort of drip feed of circumstantial evidence that the opacity of the market is being taken advantage of by the main players in that market. And again, you can't set the gold market aside from the way markets in general have evolved. Market leaders, those who control the trading, control the liquidity, they want control of the information. And the easiest way to control information is to have at least some opacity around the way the dealing is actually done. This has applied in the past to securities. It's applied to in the past to foreign exchange, and to some extent, it probably still applies to those markets today. I think it's kind of naive to sort of think that the gold market is fundamentally different. The only fundamentally different thing about it is, of course, the physical nature of the gold, whereas securities and foreign exchange don't have the same physical attributes that gold has. And in a way, that makes the gold market particularly sacred, and one that you would not want people to be messing around with. But in principle, look, fraud is fraud. And in principle, sadly, opacity promotes fraud. And if the LBMA were serious about being more transparent, and they always say they are, certainly there are more things they could do to promote that.
I'm always shocked at the way that they claim they're transparent, but really when you go and start looking at it, they're not. And it's the same as the financial media in London, Bloomberg and Reuters. I was talking to somebody recently about this, about the fact that they don't really do investigations. They have the resources to do that, but they've never really done a proper investigation into how the OTC gold market works in London, or the silver market for that matter. And it's sort of like the mainstream media is compliant in that opaqueness because they don't try and make it more transparent. I've noticed that when you're talking about gold, you often mention it in terms of portfolio diversification, and that there should be a sort of range of asset allocations to gold in an existing portfolio of stocks and bonds. And sometimes I read academic research about that, but the figures sort of change depending on who's done the empirical research. What would be your rule of thumb or guideline if you were advising clients about putting gold in an existing portfolio of their assets?
Yeah, so what I normally do, right, is I try to give people some historical perspective here. I try to say, look, if you want to trade the gold market, that's fine. Trade the gold market. Give yourself a risk budget to, trade the gold market and see how you get on. Now, that said, if you believe the gold market might be somewhat manipulated from time to time, then you're probably at a disadvantage vis-a-vis the insiders. But if you honestly, truly believe you've got a robust system and you can trade the gold market and generate good returns, go ahead. However, if your purpose of owning gold is to try and make a portfolio, an investment portfolio, more robust to all economic environments, that is to try and make sure that you simply are structuring your investments in a way that help to protect and grow, hopefully grow your wealth, notwithstanding whether we might be in an environment of healthy growth, weak growth, high inflation, low inflation, outright deflation, whatever it might be. Yeah. If you take a long-term data set and you say, okay, let's chuck in a benchmark stock index, let's chuck in a benchmark bond index, and let's chuck in some gold. And you just solve for the efficient frontier. If you look back a century or more, and yes, the data exists, you can do this, what you find is that gold should be around 10, maybe 15% of a portfolio. And that comes in not so far out of line with what I think many mainstream people would say. They might say that's a little on the high side, but then a lot of these people just don't go back quite far enough. But the funny thing is this: if you focus only on the Bretton Woods period exclusively, that's when you really see a sea change. And in fact, you want more gold, not less. The people that don't go back very far, they tend to go back 10 or 20 years. But you have to include the 1970s because there was all this pent up upward price pressure on gold coming out of the Bretton Woods system during the last few years, of which everyone knows the gold price was suppressed. That's in the open. That's in the clear. Historians can't disagree about that. The documents are all there. Now, you can disagree about the precise motives behind that suppression, who was executing it, and precisely how. But the fact that it was going on, we know, and everyone knows that now. So if you include the 1970s, the post-Bretton Woods analysis of a portfolio, stocks, bonds, gold, actually says you want to have as much as 20% of gold in that portfolio as a baseline, and I stress this, as a baseline position. However, if you think, well, wait a minute, is this really baseline given that we've got record debt, huge rates of growth in money supply, all kinds of potential financial and general economic instability, geopolitical risk, populism, and you go through all this stuff and you think that, gee, maybe things today are actually a bit riskier than the baseline of the 1970s to today. Well, then 20% is the starting point. That's the floor. And then you add to that based on just how concerned you are about the state of the world.
Yeah, because everything that is happening right now, if you look at Ukraine, which we'll talk about in a minute, and the possibility of a revalued monetary gold in a new system. Even on the political front, former liberal democracies look like they're going towards authoritarianism, and they're clamping down on people's freedoms. I remember you writing about, you say that when there's big shifts economically and in the financial markets, the gold price will change behavior because it will reflect those huge geopolitical shifts. But in the political arena, with all of what we're seeing now in Canada, Australia, New Zealand, Austria, Germany, and the crackdown on civil liberties, should the gold price be reflecting that? And what's your view on this shift that's happened in the last 2 years?
Financial markets, and that I would include gold here, find it extremely difficult to incorporate what are kind of binary geopolitical and other general political risks into their pricing frameworks. It's just an extremely difficult thing to do, and because there's no right answer, and there are so many historical examples of this, right? The London stock market was still trading, and this is true of New York as well. The London and New York stock markets were more or less trading as normal all the way into early August 1914. I think when you look at the relationship that gold has to things going badly wrong, I mean, hopefully not as badly wrong as World War I, but badly wrong. I think you can only approach it as an insurance policy. You either have the position or you don't. And the idea that somehow there's a correct price for a given risk, I think isn't the right question to be asking. The question is, how concerned am I about the state of the world? And therefore, how much portfolio insurance do I think I'm willing to hold at this current point in time? I think that's a much better approach to it.
Even this week, the events in Ukraine seem to be hotting up with a lot of political back and forth between the US and Russia. What do you think is the ultimate aim of this? Is it just regional dominance? Or is it about gas pipelines? Or is it just showmanship at this stage?
I think all of those are playing a role. But what I would say is this, is that you need to look back in history here a bit, at least to the end of the Cold War. Now, some people would say you even have to look back at the world wars of the 20th century. I think that may or may not be necessary, but you certainly need to look at least back to the settlement that occurred at the end of the Cold War, when Putin was still a relatively young man, early in his career, at the KGB at the time, later entering politics. And it was very clear to Russians as they saw their empire crumbling due to mismanagement, overextension, whatever it was, right? Fundamental failure of communism, call it what you want. Yeah. It was very clear to them that the United States and NATO were offering an olive branch, and basically saying, look, if we can agree a way to do this peacefully, and if we can agree a way to reunify Germany peacefully, we promise that NATO will restore something along the lines of the so-called cordon sanitaire that existed in Eastern Europe during the interwar period as a buffer between Germany and Russia.
Yeah.
As we know, that buffer was violated repeatedly by Germany, and then also by the Soviet Union, and the Second World War begins. But it did buy time, and in principle, it was a good idea to have this buffer zone. So Russians had this understanding that included Vladimir Putin. They had this understanding that this was going to be the settlement, and it was going to give Russia a time to rebuild following the crumbling of the Soviet Union. And indeed, when Putin assumed power, he saw that as his job, I believe, and I think those who support him, call them oligarchs if you want to, but I think that they also understood, hey, we're here to rebuild Russia and turn it into a proper, modern, powerful country. Maybe a somewhat autocratic one, maybe whatever, but we're going to take advantage of our natural resources and get to work here. I think along the lines of doing that, I think Putin has become ever more of a Russian nationalist. I think he feels quite successful now at having shored up Russia itself. And now I think he's increasingly concerned about providing for the security of Russia and Russia's borders using that newfound confidence and strength. And so when he sees evidence that NATO has not only been pushing, but wants to continue to push its influence to Russia's border, he sees, from his perspective, a need to push back. Ukraine in particular is the most exigent need to push back. And that, of course, is where this particular confrontation is coming to a head. As many people do not know, once you move east of the Dnieper River in Ukraine, especially southeast, the population is as much as 80% or more ethnically Russian. And Putin sees himself as their protector. He sees himself as their champion against what many Russians regard as a somewhat tyrannical NATO puppet Ukrainian government. Now, again, people might disagree with that characterization. I'm just saying a lot of Russians see it that way. And so they support Putin as kind of the champion of these ethnic Russians who were theoretically imperiled by the Ukrainian government that doesn't recognize their right to self-determination. Just like the same sort of thinking that got us into World War II, for example, this whole self-determination concept, which sounds great on paper, but boy, does it lead to messy nationalist politics from time to time. So that I think is kind of the ultimate cause here. The more immediate cause is what has happened in Ukraine since 2014. Huge evidence of foreign involvement with that government. Very recently, the shipment of arms from both the U.S. and the U.K. to the Ukrainian military, some of which are quite advanced, and where Russia has said, you really shouldn't do that. I mean, this is sort of red line territory for us. I hate to say this, but I think that Russia, they see a persistence on the side of NATO, and I suspect the mentality in Russia now is, we are going to have to fight Ukraine at some point, so we need to choose the best moment. The best moment is probably before the US and UK pour tons and tons and tons of advanced military equipment in there, train up the Ukrainian military how to use it, and they then deploy it to the front lines. And I have no idea how long that's going to take, but I doubt Russia's going to wait that long to attack.
So that's another geopolitical risk, a big risk to look out for. And it will probably, if it did go to an invasion and a conflict, increase the sanctions against Russia. We won't really have time to talk about Russian gold and the fact that they've augmented their gold reserves by 500, 600% over the last 15, 20 years. But staying in the region, I was interested on your view of, everybody knows about like China and Russia increasing their gold reserves. But in Europe, there's two countries which have recently increased their gold reserves over the last few years, which you wouldn't have expected really, and that's Poland and Hungary. And on a political front, you got Orban, the Prime Minister of Hungary, and then you've got, I think it's called Morawiecki in Poland. And politically, they're very independent, even though they're in the EU. The two currencies, the zloty and the florent, aren't in the euro. And the two central banks are plowing ahead independently, buying huge amounts of gold. And not only doing that, but they're publicizing it, and they're writing like pages long documents about why they've bought their gold. Do you find that interesting that these two countries, which are sort of independent and they do whatever they want in Europe, are doing the same in a monetary gold front?
I do, and I think that also has a lot to do with EU politics, because the governments of Hungary and Poland know what happened to Greece when Greece tried to act independently of the EU and the ECB with respect to the financial crisis and a possible recreation of a Greek drachma national currency. And so I think that there is far less support now in Poland, Hungary, and I would also put Bulgaria in that mix for rushing headlong into joining the euro. But if you're not going to join the euro, if you're going to retain your national currency and a degree of financial and monetary independence, you might need to take other measures to bolster confidence in your banks, in your money, and so on. And actions speak louder than words. And as we know throughout history, if you want to bolster confidence internationally, acquire some gold. So I think that all kind of fits together. It's not just that they're worried about NATO and Russia getting into a tussle, which would be awful for all of them, clearly, but there's also this EU/Euro uncertainty. And the need, or their perceived need, for independence and flexibility on that front, which is perhaps of even greater importance, because that's kind of an existent and immediate concern, whereas nothing's properly kicked off, and hopefully won't, between Russia and Ukraine.
Yeah, and Poland even announced recently that in this year, 2022, they want to buy even more gold, another 100 tons. So that's something we should look out for during the year. Ireland was the only country, apart from Hungary and Poland, which bought a little bit of gold, I think about 3 tons. I'm not sure of why that happened, because unlike the Poles and the Hungarians, the Irish Central Bank won't say why they acquired gold. I wanted to explore...
That may, I mean, Ronan, just quickly, that may just be pure financial prudence, right? When, here you are, you're Ireland, you have essentially zero influence over global monetary affairs, yet inflation is soaring everywhere. Central banks, it's not clear they're going to do anything to try and keep up with it with respect to interest rates. And yet the Bank of Ireland is sitting on all these euro assets, sterling assets, dollar assets. Well, gee, if all of those assets are going to start depreciating in real terms, maybe you should acquire a little bit of gold as diversification. They might be thinking just simply like an investor, rather than someone needing the political flexibility to act depending on what happens in Brussels or Berlin or Moscow.
Yeah, it's interesting that Ireland did that independently. They must have got the go-ahead from somebody in the ECB in Frankfurt, but I remember that the governor of the Central Bank of Ireland, in a speech, I think back in September, did raise the issue of heightened inflation. So maybe that's his personal thinking that led to the investment decision. You've done a huge amount of research and writing about the gold standard in the 20th century, 19th century. And then we know that from around 1971, when Nixon broke that link with gold convertibility, everything changed. But I noticed recently when I was researching for our discussion, I came across a few articles which all seem to have a common thread. One of them was by Mises, Ludwig van Mises, where he had written a treatise, I think, called Human Action in 1949, saying that literally the gold standard was responsible for peace, prosperity, wealth, and human liberty. And even Alan Greenspan back in 1967 wrote a 5-page article about gold. It's famous about how he really liked the gold standard, and it was something that the statists, the governments which want to print to infinity, hate because it doesn't allow them to do that. And he linked gold with liberty and freedom. And there's a 1995 article by a guy in the AIER, the American Institute of Economic Research. I think his name is Richard Salzman. His article is titled Gold and Liberty and Human Liberty. What do you think is it that gold, having a gold standard, creates this ability to have human liberty and independence from the statism?
Well, look, you can organize human affairs in various ways. You can organize them in ways that are based primarily on objective reason. That is, being able to use logic, reason, maths, science, and to see the world in a way where people can agree on a lot of things. You can agree about the force of gravity. You can agree about the sun coming up tomorrow. And gold is an objective point of reference, which is non-manipulable at least not in the aggregate, by human beings, right? Because it's created by, the universe, Mother Nature, God, call it what you want. And so it becomes an objective basis for a point of reference in human affairs with respect to who owes what to whom, that cannot be fundamentally manipulated. Whereas the moment it becomes a human creation in of itself, then it is subject to manipulation right from the get-go. And this is one reason why, of course, the Bitcoin crowd gets so excited about Bitcoin, because the algorithm was created and set running, and there's not really, no one's really able to change it now. Well, that said, people change it around the margins and they stack and layer stuff on top of it, but they kind of like that. And I think there is something. I think people who think in, according to logic, reason, and science, the scientific method, and things like this, I can see how they're drawn to Bitcoin for those reasons, but then the same reasons largely apply to gold. And in fact, gold goes one better because there was no human or group of humans needed to create an algorithm in the first place, right? Gold just is.
Yeah.
So it really is the ultimate money, the ultimate objective reference point in that case. And so one reason why I think you can say that gold has historically been associated with relatively high degrees of economic freedom and liberty is for that reason. It simply is a higher quality money. It is a money that was not created by and cannot be easily, if at all, manipulated by man. And that builds trust, and that builds confidence. And trust and confidence are essential for long-term investment, which is essential for economic growth. It's essential for the division of capital and labor. It's essential for civilization. And that is civilization that goes beyond, say, Stone Age levels of organization. And so I believe all of this is kind of associated. And when you look at history, you see those associations. They do change from time to time. There are setbacks, big setbacks from time to time. But the path of human progress in socio-economical terms, and that includes recognition of individual rights, it includes things like Magna Carta, have links to gold. And it's actually not that difficult to uncover those links. And I believe that, in fact, we are in process, slowly but surely, of rediscovering those links, given the increasingly apparent costs of having severed some of those links over the past half century. And you mentioned one of them, of course, very, very symbolic signpost of Nixon closing the gold window. But to be fair, gold was already dying behind the scenes, at least temporarily, prior to that particular high-profile event.
Yeah, and I don't know whether you saw the article I wrote back in August. It was for the 50th anniversary, that it was actually triggered by Roland Baring, Lord Cromer, who was the British ambassador to Washington at that stage. But literally that was just part of the process, because as you say, it was dying, and they knew that maybe they did ask for some gold back, and the French did similar. I was going to ask you about, that website, we can't really mention the name because it's a family show, but it's the WTF 1971. Literally, it's a website of charts which shows that 1971 was a pivotal point. Since then, if you look at like productivity, our wages, our happiness versus wages per hour, everything changed in 1971. And that was when the link broke to gold and government started printing ad infinitum. And even like right now, 2022, that's still happening. So is it literally the fact that the break to gold changed everything? Economic charts, metrics, comparisons?
Look, if you corrupt the money, which is, again, the basis for third-party exchange, without which modern civilization is impossible. If you corrupt the money, you end up corrupting everything. And that may sound a bit shallow, and people say, oh, money isn't everything. Well, hold on. When it comes to supporting a modern civilization where you're doing business indirectly with people all over the world every day, whether you're aware of it or not, that money is so unbelievably essential to everything. We are material beings. Technology, that is modern technology, does not change that we are material beings, and we need to interact with other material beings in order to satisfy our potentially infinite needs, wants, and desires in hopefully a reasonable way that does not impose on other people's freedoms and liberties in their own right. you begin corrupting the money and you start blurring all of those lines, economic, social, political. And it's hard to tell what's actually happening, who's in charge, who's responsible, who's accountable when it goes wrong. All of these sorts of calculations, absolutely essential to trust, confidence, everything that underlies the success of to the extent they are successful, political, moral traditions of modern civilization. All of that, in theory, gets undermined by corrupting the money itself. And in fact, people that haven't even looked at it that way really don't. I don't think they're almost qualified to talk about some of the social phenomena that we have observed in recent decades regarding the structure of a family, the relationship of a family to the broader community, the relationship of communities to national governments, the relationship of national governments to supranational governments, the relationships of the private sector to the public sector, the relationships of regulations to entrepreneurship. If you don't look at the money itself, you actually don't fully understand how or why those relationships have been changing, for better or worse.
And if gold was uncorruptible money and money which allows freedom and human liberty, what would you define central bank digital currencies, CBDCs, as? That's a new ominous threat because that's full control by central banks over the affairs of its citizens.
Absolutely. I mean, the single biggest criticism that pretty much everybody levels at fiat, I mean, to the extent that you want to criticize it, is that the cost of creating money approaches zero. And therefore, of course, the cost of fiddling around with it and manipulating it, at least in the near term, approaches zero. And so if you think you can benefit one group at the expense of another and that that's politically convenient, well, then sure, go ahead and manipulate the money in the short term. It doesn't cost you anything. CBDCs simply make it even cheaper and more efficient to do that. Do you really want to give more power to the institutions that have been abusing the power they've already got? Sounds like a bad idea to me.
You are the head of treasury for TallyMoney, which is a gold-backed currency where you can save and have an account and spend off of that balance. Could you tell us about TallyMoney?
Well, TallyMoney is an attempt to be part of the solution here and to do so with an entrepreneurial private sector alternative to the way most people go about saving and also making payments and interacting with the banking system. Now, what Tally does is we try to basically remove the friction between the gold market, the retail, I stress retail, between the retail gold market on the one hand and the day-to-day need for the ability to interact with the payments and banking system on the other. Look, people like me who think that it would be great to go back on some form of gold standard, we can wish for that all day long, but the practical reality of the world as we know it is that is not currently the world which we inhabit. And so what's the next best thing? We can try around the margins to do things that nevertheless allow us to maintain our liquidity, our excess liquidity, in what is effectively gold, without that being directly subject to the risks of devaluation and default of the banking system. So in other words, not holding your excess liquidity in a typical bank account, but holding your excess liquidity in another account that is gold backed. And what's nice is that the growth of the fintech payments industry actually makes this possible because the fintech payments industry is a very low friction industry. That's why it exists. It's trying to reduce the friction that a lot of banks have in their payment systems with respect to retail. I stress this, with respect to retail. And so what we've done is we've partnered up with a cutting edge fintech payments platform, which has full integration with the banking system, full integration, IBAN numbers, cards, debit cards, you name it. And yet we simply provide this back end of providing the real-time physical allocated gold backing necessary to fully reserve that entire payments platform. And so we're trying to take advantage of the low friction solutions of the cutting edge fintech payments platform with the store of value and outside the banking system, credit risk free benefits provided by that gold backing. Now, there is a cost of doing that, but we've reduced the cost to a level which is far lower than what a typical person would incur were they to be going in and out of the gold market day to day, week to week, month to month, or even year to year for that matter, to try and do something similar on their own behalf using gold custodians on the one hand and a payments or bank platform on the other.
I guess you could call it like Revolut backed by gold.
In a way, yes. Now, Revolut's been hugely successful, and they're going in all kinds of different directions now, and more power to them. But yes, Revolut is one example among many of very successful fintech payments platforms that are actually beginning to branch into other things. We are focusing on doing one thing as well as we possibly can. That said, the payments platform that we partner up with do have some future plans to also expand in some new directions. But for us at TallyMoney, the single priority is preservation of wealth and protection from the banking system, yet with the convenience of a typical low-cost fintech payments platform.
It sounds fascinating, and I'll definitely check it out. I think we've only got a few minutes left, and it's been a really interesting discussion, and you've really brought together everything from the historical point of view and the contemporary point of view. But looking to the future, do you think that we will ever see a new gold standard, our gold being the anchor of a new international monetary system? And could we wake up one day and the central banks will have announced it? I saw yesterday Zero Hedge had a tweet which was quite kind of tongue-in-cheek. They said that if the US Fed went to a gold standard, they'd solve their inflation problem in 15 minutes.
They would. They'd solve it by accepting a huge surge of inflation during that 15 minutes. And from then henceforth, there wouldn't be any more. So I doubt they're going to make that choice, but in theory, it could be done. And I've proposed how it could be done. Jim Rickards has proposed how it could be done. Back in the day, Murray Rothbard and Harry Brown proposed how it could be done. And would you believe it? Alan Greenspan proposed how it could be done. He wrote an article in the Wall Street Journal in the early 1980s. Laying out a framework for how the U.S. could return to a gold standard and do so in a way that wouldn't be particularly disruptive, if at all. So, many people have thought about this topic, and so Zero Hedge is just the latest to chime in on it, I suppose. Look, I believe we are going around in what I call the monetary cycle of history, from good money to bad money, and then back to good money again. History demonstrates this monetary cycle very clearly. We've been through, iteration after iteration after iteration of this, and you can see it in the history books. And I believe we're in one of those now. And the reason why it works this way is, of course, let's face it, the world's an imperfect place, and governments sometimes make expedient choices with bad long-term political consequences. And one of those is to debase the money. And we've seen this so many times throughout history. And of course, in many cases, the money becomes so debased, it's just thrown out in the end and you start over. And when you start over, you always, and I stress this point, you always start over with precious metals. Not always gold, sometimes silver, but you always start over with precious metals. Because that's the only way to restore credibility once you've really blown things up. And so, why is that? And the reason why is this, is that if you're going to restart something and you've blown through your credibility and you've destabilized your country, possibly to the point of revolution and war, really the only way to truly restore confidence across borders internationally, where people have different legal systems, speak different languages, have different customs, right? Different religious beliefs, you name it. The one thing that you can still agree on as human beings is, hey, could we please use logic, reason, the scientific method, and some objective, sort of observation about this world we live in to sort of still get along, to restore some stability and confidence and hope. When it comes to the money involved, that's going to be precious metals, because per our earlier discussion, that's really the ultimate way to restore some degree of confidence, trust, and objectivity in monetary affairs, whether it be domestically or internationally. In the modern economy today, I actually think it's the international system that's more likely to catalyze a return to gold-backed money. And the reason why is because no one country wants to unilaterally, give away its printing press and not be able to print. But when they all pressure each other in equal measure, then you get into a John Nash equilibrium style game theory dynamic in which the interest of all the players, right, may diverge, but they all want to position themselves to satisfy their own national interest as best they can, given the differing interests of all the other players. When it comes to international monetary affairs, the only way to solve for that Nash equilibrium, where everyone can sort of agree, yeah, well, okay, we can trade on that basis, a basis that doesn't favor any one country over every other, but it's a fair, level monetary playing field internationally. Gold is the only substance that can solve for that Nash equilibrium. It's the only one, and that's why I believe we are someday going back to gold.
I noticed that you wrote The Golden Revolution in 2012 and The Golden Revolution Revisited in 2017. So that was 5 years between the two. Another 5 years has now passed and we're in 2022. Could we be seeing a new book about the gold standard reborn? Any plans for a book this year?
You're not the first one to ask the question, Ronan. And I have given that some thought. Certainly a lot's happened over the last 5 years, and a lot of it, in my opinion, sort of vindicates some of my somewhat provocative thinking that I put forward. Again, I'm kind of standing on the shoulders of giants here. I'm not the only one to have thought about these ideas. I do like to think that I've put them together in a way which is unique to myself in that regard, and hopefully contributes to the debate. But it's hardly all my original thinking here. Absolutely not. So along those lines, do I feel like I've managed to stand even a tiny bit higher on the shoulders of giants during the past 5 years? There are a couple of areas where I think I have learned a few new things and where perhaps I could make some new contributions to this debate and discussion about what I call the monetary cycle of history. And so I have thought about it. I'm awfully busy right now with various things, but who knows? Maybe in 2023, I'll do? I'll blame COVID lockdowns for having interrupted and slowed me down, but maybe I'll get it out next year.
Okay, we'll all be on the lookout for anything you write. So it's been a pleasure talking to you, John, and definitely in this hour we've made up for the fact that we didn't get a chance to talk for very long back in 2014 in London. So thank you very much for your time, and I know that everyone is going to enjoy your thoughts and your views immensely. So thank you.
Well, my pleasure. It's been a great discussion. Let's do it again.
Yeah, definitely.